I'm sorry, Auntie. I've been, putting my house in order. Okay. Um, all right. Let me share the screen. Uh, we are going to embark on accounting for companies as you tasked me to do. So we shouldn't waste much time on that. Let me
Yes.
just dive in. Mm, I'm sure you are seeing something on the screen.
It's downloading.
Downloading.
Yes.
You're not seeing anything on the screen?
No, I'm seeing it now.
You're seeing. Okay, that's fine. That's fine. All right. Okay. Um, the assumption here is that we know what accounting is all about. Okay.
Yes.
Just to remember the
Yes.
definition, just to remember the definition of accounting.
Yes, yes, I still remember.
What is accounting?
Accounting is the hello?
Yeah, I'm listening.
Hello, sir, can you hear me?
Yes.
There's something here. Can you hear me now?
Go ahead.
I'm heavy.
And delay. Ending.
Sir, can you hear me?
Yes.
Accounting is basically the summarizing and recording of business transaction.
Okay. That's great. Mm. So we are now going to focus on limited companies,
Okay.
um, which are different from sole traders. Limited companies are a formation of legislation. They are different from sole traders because in these companies, we are going to have a lot of things. For example, in terms of ownership, they are owned by people who normally are not the people who are going to manage these businesses. Unlike a sole trader, where the owner is the manager. But here now, there's now separation between those who own the company and those who are going to run it. Are we together?
Yes.
Now, the word limited simply means that in case of trouble, in case of trouble,
Okay.
the owner's liability, for example, if the owners were owning other people money, their liability is only going to be limited to their shareholding or to the outstanding shares, to the outstanding share capital. They didn't, uh, they didn't acquire. For example, if the authorized share capital is 1 million, but the shareholders have only managed to raise $570,000.
Okay.
When the company is liquidated, that balance which they didn't contribute is going to be chased upon them. All right. So their liability is limited to their balance, to the outstanding balance alone, not anything more. So if the lenders were being owned about $2 million, they are not going to be able to chase the shareholders for the outstanding 2 million. They are only going to chase after the shareholders for only that amount the shareholders did not contribute. That's the aspect of limiting. So these companies are protected by law They are established by law, so everything is going to be is what the law says. Are we together?
Yes.
Good. So, basically, by the end of this lecture, you should understand the key carbon features. You should understand the main accounting aspects related to limited companies, the format of their financial statements, all those things, as well as the computations, usually which are linked to limited companies. That's what basically we are going to do. You also appreciate things like preference shares, uh, the share premium, the share capital. You also understand rights issues and bonus issues. Just give me 1 minute. I'm just finishing, my breakfast.
It's okay.
Look, Auntie. Hi, Auntie.
Yes, eh?
Okay, I'm done. Um, Now let's look at the key common features. I've already preempted some of them, but this is just a recap. There's what is called separate legal entity. It's actually a principle, okay?
Okay.
Separate legal entity. The company is distinct from its owners. So it is actually separate. This is in line with the separate business entity concept, where even for the shareholder, for the sole trader, his business is actually different from him. However, it is not limited. In the case of the shareholders, when they eventually liquidated, the lenders are going to pursue them individually or personally. But in the case of a limited liability company, the owners are only going to be pursued. Their liability is limited, as you can see here. The shareholders are not personally responsible for debts beyond their investment. All right, beyond their investment, which means beyond their shareholding, they are not going to be pursued. But in the case of a sole trader, he will be pursued. So, in a sole trader situation, the business, although in accounting sense, is separate from the owner. Um, in terms of the handling of whatever liability, they are considered the same person. So you can't say, no, my business is separate from me. If you're a sole trader, it is not separate from you. You are one and the same thing. But in the case of a company, those things are separate. Is that clear?
Yes, eh?
Now, separation of powers. Yes, I told you that, these companies their owners are not usually the people who are going to run them. There is what is called the board of directors, right? As you can see on the on this image, on the image
Yes.
illustration. Um, that's the board, okay? The board of directors. They're the people who run the company. When the shareholders, usually many companies have got so many shareholders. You might be having a company, for example, okay, Zimbabwe or TM Hyper. Those companies have got so many shareholders.
Yes.
Do you get it?
Mm-hmm.
So there is then so those shareholders do appoint what is called the board of directors. Only a few would be having the managerial powers to run the company. So there is separation of power between the
Okay.
owners, between the owners and the directors who are the managers. And we have already pointed out at one of the lectures where we said that if there is that separation, there is what is called the agency problem. The agency, because managers are agents. Okay, the agency. There is a C there. Agency problem. The agency problem emanates from the fact that the directors who are managers usually pursue different motives or objectives from the owners of the company. They normally
Okay.
pursue things which benefits or which benefit them more than the shareholders. There's always that risk that these agents, they are actually agents. Agents, the spelling of agents, an agent. You know the spelling of an agent. An agent works
Yes.
for an agent works for the principal, right?
Mm-hmm.
So the principal is the owner of the business, who is the shareholder. But the problem is that the agent, who is the director of the company, normally pursues short-term things, like for example, good paychecks, you know, those perks. They want good cars and so forth. They want bonuses and so forth. But the shareholders would be looking for something that is longer term, that is long term in nature. They want their share price to rise over time. They want to benefit more in the distant future than in the current future. But agents now, they want good life today. They normally want good life today and not in the future. They feel that in the future, perhaps they might be dead or they might have left the company, all those things. So there is always a friction between the two. Is that clear?
Okay.
But we
Yes.
cannot do anything about it uh, because usually the shareholders are going to be busy with something else. There are people who just invest money and they expect their money to grow, but they don't have the time to run the day-to-day affairs of the business. So they end up hiring other people. So it's something like it's systematic. It's something that is going to be there whether they want it or not. Because if you don't want it, you then have to be the manager, but you don't have the time. You only have got the money to invest. So you are going to be forced to hire other people. This is why these limited companies are forced to or to abide with so many statutory rules. They need to abide with tax rules, with employment rules, with financial reporting rules. So by the end of the day, the risk of to shareholders is to some extent manageable because of those controls which are in the economy, the regulatory controls. So this is why we stated here on this part that there is normally heavy regulatory requirements, regulatory rigor, higher formalities, including mandatory disclosure and audit requirements. So these companies usually are subjected to audits and other regulatory requirements. Is that clear?
Yes.
Now, financial statement issues which we need to consider. Um, the financial statement layout. Remember, financial statements are for public consumption. Usually, they are for public consumption, the shareholders and the government. So, limited companies file summarized accounts. Remember from your definition of accounting, they
Mm.
file summarized accounts with state authorities for public access, distinct from internal management versions. So usually the statements which are filed are summaries. They are not that detailed as management accounts. All right.
Okay.
Now, the aspect of capital and equity. Capital is presented as equity in the financial statements of a company. All right. But in the in the sole trader, we were only going to say capital. All right. It wasn't share capital. It was capital, all right, in sole
Mm-hmm.
traders, but in the companies, it is now equity. All right,
Okay.
equity. This equity has got the share capital, has got reserves. We talk of share capital, share capital. We also talk of what? Reserves. Do you get it?
Mm-hmm.
In reserves, we talk of reserves themselves, we talk of retained earnings, and so forth. There are so many reserves, right? But they all fall under equity. All right. So um, that's the idea. Now, there is an aspect of corporation tax, corporate tax. As a separate legal entity, the company pays tax on its own. It pays tax. This tax appears as an expense in the statement of profit or loss and a current liability in the statement of financial position. Okay. Now, we have got this format, which is the format for the statement of profit or loss, but you need to pay attention because there have been some changes in the way this statement is presented, and it is now called the statement of financial performance. All right. It's now called the statement of financial performance. All right. So the statement of financial performance includes the statement of profit or loss and the statement of other comprehensive income. We know that, and we'll be used to it as we proceed. All right. So basically, we start with the revenue item, the revenue, cost of sales, gross profit, other income, distribution costs, administrative expenses, finance costs, profit before tax, the company tax expense, the tax expense, which we have been talking about, and then the profit for the year. But now, here is the new presentation. I'm sure you are seeing it clearly.
Yes.
Good. Of course, this one has been adapted from the ACCA, the ACCA Financial Reporting Examiner article. All right, that's where we took this one, but it's very, very essential. At financial accounting, we shouldn't worry much about the presentation, but it's good for us to appreciate what it looks like because IFRS 18 is the current standard with the current format. Okay, so it's also good for us to actually work with the new format. So, like I said, it is now called the statement of financial performance, as you can see there. Financial performance. Here it is for the group. Okay, the name of the company, as you can see here, is the group, is a consolidated statement of financial performance, right? Do you understand? So we are talking of the group, and we are going to do groups. Don't worry. Until that was part of your instruction as well, that you also need assistance when it comes to group accounting, right?
Yes.
So we'll talk about that. So, like I said, the statement of financial performance consists of the statement of profit or loss and the other statement which is shown, which should be below the profit, which should be below this part, is this is the profit, right? Good. I mean, I don't mind the way I'm drawing, Okay, that's the profit line. So below that, there is what is called statement presenting other comprehensive income, which is the other segment, but it's not normally, required at this level. All right. So, as I have already indicated, we start with the revenue, then cost of sales, then gross profit. This one, there were no changes here, but the changes which were brought about were that you need to to note that from the revenue up to the operating profit, this is called the operating category. It is the operating category, as you can see there. That's the operating category of the statement of profit or loss, right? That's the operating category. So here we look at the revenue, as I've indicated, revenue, cost of sales, gross profit. Then we add other operating income, other operating income. Don't just say other income, because previously, as you can see here, we were saying other
Income.
other income, as you can see here. All right, but that one is not allowed anymore. Right? You need to
Mm-hmm.
say other operating income, because there are different incomes which we are going to see. Because, for example, if you come here, there is other investment income. So if you simply say other income, the examiner is going to
Mm.
be, he's not going I mean, to be easy on you. It's going to be hard. So you need to pinpoint which type of income. So we are talking of other operating income. Then after other operating income, we go to the to the operating expenses. All right, the operating expenses, we have got the selling expenses, we have got research and development expenses, general administrative expenses, goodwill impairment losses. That's where you put them. Uh, that's where you put them. All right, other operating expenses, you put them there. But you see, there are other expenses which sometimes are considered operating, sometimes they are considered part of cost of sales. The examiner is going to tell you where, what the company policy was. Sometimes the policy would be to recognize those expenses as cost of sales. For example, depreciation or amortization, sometimes it is going to be considered in administrative expenses or in cost of sales. The examiner is going to tell you where you need to post them. But at this level, again, you need not to worry much. The examiner is not going to be that complicated. Then you get your operating profits. Right? That one is mandated by the standard. You need to have that total for the operating profit. How do we get the operating profit? You first of all deal with the revenue. You get your revenue amount, you less cost of sales, you get your gross profit. After getting the gross profit, you add the other operating income, then you less it with the selling expenses, the general admin expenses, the goodwill impairment losses, uh, other operating expenses. Okay, all those things. Then you arrive at the operating profit. Is that clear?
Yes.
Good. Then after the operating profit, we go to the other category called income and expenses from investing activities, the investing section. Here we look at things like the share of profit or loss of associates and joint ventures. All right, you might not be required to know those ones, but it's good for you to be in advance. Do you understand? To be
Yes.
ahead, you must be ahead of the game. All right, so
Mm.
you consider that one, and then other investment income, you factor them in, and you get what is called the profit before financing and income taxes. That section is very, very important. Then after that, you move on to the other category, the third one, that is income and expenses from financing activities. So when we do cash flows, initially we used to take the profit before tax, if you still remember, right? But now,
Mm-hmm.
but now it's now profit before we must use the profit before financing and income taxes. So it's a very, very important figure. This one. Is that clear?
Yes.
Then we move on to the income and expenses from financing activities. Here we look at interest expense or expenses on borrowings and leases, liabilities, and then interest on pension liabilities and provisions. That's where you factor them. Why? Because these two interests are different. They are all interest expenses, but they are different. You can appreciate that previously we were just going to say finance costs, and we
Mm.
budget them there, which today it is no longer appropriate, because they say accountants were hiding a lot of things through bunching figures. So we want to separate them. So this is now how we should do it. There is now going to be some separation, of these interests. The interest from the ordinary borrowings from the bank and from leases, those ones are going to be presented in their own line. And the interest from assumptions, like from pension liabilities and provisions, then they are going to be treated in separately. But for now, do not worry much. But I wanted you to be conversant of what the changes have been. All right. Then you come to profit before income taxes. Okay. This one is a total day. That's the profit before income taxes. Then after that, you then come to the interest, to the income expense, which should be put there. And then you come to profit for the year from continuing operations, which is a total there. And then you need to then factor in the loss or gain from for the year from discontinued operations. Again, discontinued operations, we are going to talk them at the financial reporting level, and not now. Are we together? So for now,
Yes.
just ignore them. For now, just ignore them. All right. This is why I say that much of this template is not really required of us, but you need to be ahead of the game. Sometimes the examiner might be interested in testing your appreciation of these things. Then finally we get what is called the profit, and remember the way it is presented, just profit, not profit for the year, as we used to say previously. We used to say profit for the year. There is just profit. Is that clear?
Yes.
Because shareholders want information as quickly as possible. They don't want a lot of distraction. Even the regulators, just simply say profit. They will understand. Don't just write or hide it within other words like profit for the year. They end up missing it. Is that clear?
Yes.
Great. The statement of financial position. This one now shows the carrying value of the items. Only net book value is shown on the face of the statement of financial position. What do we mean by net book value? Net book value is the amount after all the necessary adjustments. Okay? The amount of an item after all the adjustments have been catered for. In case of non-current assets, we are talking of, please be at this, be with me here.
Yes.
Because I have seen a lot of guys crying over these issues. So I want you to look here, because if you don't do that, sometimes if you are not watching me, you might end up getting asleep. Okay, this is what I'm saying, madam. Please pay very careful attention. In case of
Yes.
non-current assets, for example, buildings, or let me just say motor vehicles. We normally say cost less accumulated what? Depreciation. That's what we normally say. Okay, so
Yes.
this amount is the net book value,
Value.
the amount. So in the statement of financial position, what we are going to see is the net book value.
Well,
In case of inventories, if you are talking of inventories, which are current assets, current assets. Inventories are current assets. Are we in agreement?
yes.
Inventory is valued at the what? At the lower of cost,
Yes.
at the lower of cost and NRV. Lower of cost and NRV. And that is the book value of inventory in our financial statement. But we would have done the adjustments, and the adjustments are done by looking at the lower of cost and NRV. So this is why we said only net book value is shown on the face of S of P. You do not show us all these computations. You would have done them in the background. And what you show us is the N book, is the NBV, the net book value. Detailed notes. Cost and accumulated depreciation movements are disclosed in separate schedules. Okay, you may disclose the cost and accumulated depreciation movements in the notes. Then liability classification, clear distinction between non-current, that is non-current liabilities, the loans from banks, long-term loans, all right, which are they going to be there for more than a year, are going to be non-current loans, non-current liabilities, and they have to be separated from current liabilities. Current liabilities,
Mm-hmm.
these ones are payable within a year. For example, tax, uh, trade payables, for the goods which we would have acquired from our suppliers. Is that
Yes.
clear, ma'am?
Yes.
All right. Okay. Now, let's move on. All right. Let's look at the this particular example where we are looking at ownership comparisons. We have got a sole trader by the name Charlie, okay, and a
Mm-hmm.
company by the name Delta. They
Delta.
they both made profits of the same amount. This Charlie, the sole trader in year one, made a profit of 5K. All right, made a profit
Yeah.
of,
5K.
all right, all right, and the company presumably made. Let me just write these for the same company so that we are not going to be in year one. That's 5K. They made 5K. In year two, they also made a profit of 7K, just like the sole trader. And in year three, they made a profit of 10K, the company. All right. Now, sole traders, when they make profit, they normally do drawings. What are drawings? Do you know drawings? What are drawings? Andy,
Yes, sir.
what are drawings?
Drawings is money or goods that are taken by the owner from the business.
Yes, that's correct. That is very, very correct. Okay. So traders do take drawings, right? They they
Yes.
they withdrew money out of their businesses. So when they do
Mm-hmm.
that, they reduce their profits. They take it out of their profits, all right?
Yes.
And in a way that is going to reduce their capital in a way, all right?
Yes.
Mhm. That is going to reduce their capital. All right. So the assumption here is that we also have to presume that the capital which was injected by this Charlie was 10K. Just like everything, all the figures should be the same with those ones of the company, right?
Mm-hmm.
So this guy would have uh, contributed 10,000 capital into the business. So when he made a profit, the capital had increased to it increased by 5K to 15K. All right, because of the
Mm-hmm.
profit, right? But when he made a drawing, it means that there was a reduction by 1,000. Okay, this 1,000 which he made a drawing, so it means that the capital is going to suffer 1,000 less, so it is going to come to 14,000. Are we together? So this is why we are seeing a 14,000 there.
Yes.
So in the case of a sole trader, the capital is fluid, is volatile. Profits increase capital, drawings decrease it directly. But in the case of the company, share capital remains constant. Hello?
Yes.
Share capital itself, the share capital, is going to remain constant. It doesn't change. Doesn't change. Even if when you make losses, it doesn't change. It will still remain $10,000. However, movements are going to affect the retained earnings, right? So when the shareholders withdrew a dividend, take a dividend, that's what the shareholders, gain from their investments, right? They earn a dividend.
Yes.
Do you understand?
Yes.
But sole traders, they do what are called drawings. But these companies, they offer dividends. Exactly. So
Yes.
these dividends are taken from retained earnings. Retained earnings are the accumulated profits, the profits which were not used by the business or were not reinvested into the business. They were kept as they are. So those retained earnings, if they are not reinvested, they sometimes are used to pay the dividend. Okay. So
Mm-hmm.
the retained earnings, okay, like I said, they are accumulated profits. They are profits. Okay, but the term we normally use in companies is retained earnings. Okay.
Mm-hmm.
Is that clear, madam?
Yes.
Uh-huh. So, as usual, the company made 5,000 profit, but there was a dividend of 1,000 which was paid. So the remaining retained earnings are now 4,000.
In. Okay.
So if we add 10 plus 4, that's 14,000. So we are still on the same page with this guy, with Charlie. All right.
Yes.
Um. Now, in year two, Charlie made a profit of 7K and drawings 2K, but his capital now is 19,000. How did we arrive there? Remember, remember, our closing capital was 14,000, but
Yes.
we made a profit of 7,000. So 14 plus
Seven.
7,000, that's 21,000, right?
Yes.
Minus the drawing of 2,000. We come to,
19,000.
are you following?
Yes.
Good. Let's come to companies. In year two, in year two, we made a profit of 7,000. Hello?
Yes.
When we made a profit of 7,000, our share capital remained constant. Okay? The share
Mm-hmm.
capital, the share capital remains constant. However, because we had, remember, we had retained earnings of how much?
9,000.
Uh-uh. Our retained earnings were how much? How did they reach 9,000, our retained earnings? Hello?
Okay. Yes.
Because remember,
Mm-hmm.
in year one, we had 5,000, but we took a dividend of 1,000. All right?
Mm-hmm.
But but in year two, the assumption is that we also took, remember, for companies, you must just equate with the drawings. This for companies, there will be dividends, right?
Yes.
Dividends. So in year two, how we obtained the 9,000 is that the retained earnings initially were 4,000. This were that was the balance at the end of year one. Okay, but we made 7,000.
Okay.
7,000
Then we
profit,
had to
remember, and then we
the
deducted what?
the
2,000.
2,000,
Do you get
and
that?
then we said the 4,000 that we made last year plus the 5,000 that is left this
Yes.
year. This year.
Do you get it?
Oh, yes.
That's the 9,000. Then the
Okay.
total equity. Remember, I said equity. Equity is share capital plus reserves. You get it? So
Yes.
total equity is 10,000 plus the 9,000, and we get 19,000. Share capital doesn't change.
Yes.
Is that clear?
Yes.
Lastly, for year three, let's do year three now. We are running now. So year three, the profit which was made was 10K. All right. And
Yes.
they made a drawing of 3K, and they arrived at 26,000. How did we arrive at 26,000? That's the question. Okay.
Okay.
Uh,
So we say for last year we had 9,000, right? And then this year on the third year
no,
we made
we are we, we
10,000.
we are on Charlie. We are on Charlie.
Or you and Charlie, or
Mm,
not, or on the company. All
mm,
right. So Charlie made 10,000 K
profit.
profit.
Uh-huh.
Then he took drawings worth 3,000.
Mm-hmm.
And then we say that 7,000 that is left plus the 19,000 closing capital that we had on the second year.
Yes, because our closing capital was 19,000, which was
Yes.
increased, by 10,000 to 29,000, and reduced by the drawings of 3,000 and become
Yes.
26,000. For the company,
Yes.
for the company, we had the share capital of 10,000 and retained earnings of 16,000. We arrive at 26,000. And now the 16,000, we now know how to reach to the 16,000, isn't it? Or we are confused again.
No, we are not
Uh,
confused. No, we are not confused.
How do we arrive there?
At 26,000.
At 16,000. This
At
returned.
16,000.
Mm.
Okay. So we say auntie, we had 9,000 for last year, for the second year. And
Yes.
then we say plus the 10,000 that we made on third year.
Yes, this
And
one.
then we then list the 3K dividend.
Yes, the dividend. Uh-huh.
Then we are back now at the
26,000.
16,000.
At 16,000, yes. And
Yes.
after adding the 10,000, we get the 26,000, right?
26. Yes.
So that's the type of activities that will be happening in the background. Is that
Okay.
clear?
Yes.
That's what will be happening. I am glad you are mastering the concept. Now, how do we account for dividends? Here are the crucial rules. Cash flow dependent. Dividends are recorded only when paid, not when proposed. So sometimes you hear the examiner say they proposed a dividend of 10 million, but you'll be tempted to come up with an accounting journal. No accounting journal there because dividends are only recorded when paid, not when proposed. Retained
Okay.
earnings, retained earnings, these ones entails that the dividend should be subtracted from equity, not an expense in the statement of profit or loss. Uh, we are simply saying that the dividend should be from profits, okay, not expensed. So it should be from existing profits. It should not be treated as an expense of the business. Why? Because it is done from the profits which are already there. We pay dividends from profits which are already there, not from capital. All right. We do not treat them as an expense of the business because they are taken from profits which have already been realized. We take them from equity. Remember, the retained earnings are part of equity. I told you that equity is made up of two things: the share capital and the reserves. Retained earnings are part of the reserves. Do you understand? Hello?
Yes, I'm here.
Good. Then sometimes, as we have already indicated, that dividends are paid out of profits. These profits means that if you invest in shares at the start of the year, you are going to be paid the dividend after the company realizes a profit. That is after 1 year, after the accounts have been done. Is that clear? Now,
Yes.
sometimes it's not good for shareholders to wait for such a long time. They are normally given an interim dividend, that is a dividend paid during the year. That's the interim dividend, just to comfort them. Is that clear?
Yes, it's here.
Now, after the interim dividend, they are then paid what is called the final. This one is proposed at year end and is paid in the following year, the final dividend. Let us look at this example. Bike Motors Company has a year end of 31 December each year. During the year ended 31 December 2027, the following occurred. On 1 March 2017, they paid a final dividend for year ended 31 December 2016 of 5,000. So this was a dividend for the previous year, but it was paid in 2017, which is normally the case. The dividend is proposed in this year, but it is normally paid in the next year. So this one is is a normal situation. Then on 5 July 2017, they paid an interim dividend for the current year, for the year 2017, of $1,000. On that 1 December 2017, they proposed a final dividend of year ended 2017 of 6,000. But this one was paid in 2018. This one 2018, this one 2017. This one again was paid in 2017. State the effect of each of these dividends in the financial statements of the company for the year to 31 December 2017. So, dividend treatment and financial statements. You need to, okay, we are doing the compilation. We are doing the solution actually. We need to analyze the balance sheet, equity, and cash flow impacts of final, interim, and proposed dividends for the year 2017. Okay. The core accounting principles, the recognition rule, dividends are only recognized in financial statements when they are appropriately authorized and are no longer at the discretion of the entity. Equity appropriation dividends represent an allocation of profits to owners. Therefore, they are deducted directly from retained earnings and never impact the profit or loss statement. We talked about this. Don't worry, I'll show you the solution. IS 10 constraints. What is IS 10? Do you know IS 10? Hello?
I'm not sure. Are they not contingencies and liabilities? I'm not sure. Let me check.
Those are the IS 37. You are
Oh, those
guessing.
are.
Where are you guessing? Huh?
Are they not inventories? This one is IS7.
Inventories.
Inventories IS2.
Uh-huh. Yeah. Okay. So IS 10 is about events after report.
Oh, all right.
Events after reporting period. Okay. So under IS 10, final dividends proposed after the reporting date cannot be recognized as a liability as no present legal obligation exists at year end. We talked of, I'm sure I did a lecture with you on this one some time ago, before you ran away from the truth. Hmm? We talked of adjusting and non-adjusting events, all those things, but you've forgotten, and oh my God. So we are saying an adjusting event is that event uh, that shows evidence of existence at the reporting date. So if a final dividend is proposed after the year end, that's not an adjusting event. It's a non-adjusting event. Why? Because at year end, such a thing had not been done. There was no legal obligation. There was no legal obligation. Do you understand?
Yes.
Good. But if the proposal was done towards the year end, yes, then at year end there was evidence that such a thing was there, so we need to recognize a liability for that. Is that clear? Now let us look at these figures. Let's start with the first one on 1 March. On 1 March 2017, they paid the final dividend for the year ended 31 December 20. 2016 or $5,000. So this was the final dividend which was paid, and the amount of 5,000. This dividend was proposed in 2016, but formally authorized and paid in 2017. As it represents a transaction finalized in the current year, it must be recognized in 2017. So in 2017, we are going to witness a decrease in cash as we are paying the dividend, and we are paying it out of the retained earnings by 5,000. So what is the journal, the accounting journal? We debit what?
We debit the cash. We debit the dividend, then we credit
Yeah.
the cash.
But now we are actually debiting retained earnings, right?
Oh, all
Remember,
right.
retained earnings are profits. All right. So to reduce the profits, we are debiting the profits, right? Okay.
Yes.
Can you actually say dividend paid? So we're debiting retained earnings, in bracket dividend paid, and crediting what? What are we crediting? Obviously, we are
The,
crediting cash, because cash
yes.
is leaving our account, isn't it?
Yes.
Yeah, we are paying a dividend. So cash is leaving us. There is an outflow. Okay. What about the interim dividend, which was paid on 5 July 2017? Interim dividends are recognized immediately when they are paid. Since this cash outflow occurred during the 2017 fiscal year, it must be accounted for directly. So we are going to credit cash and debit retained earnings of 1,000, as we have done here.
Okay.
Debit retained earnings and credit cash. What about the 6,000, the proposed final dividend? What are we going to do with this one?
It has no impact on the balance sheet because it was proposed at the year end.
Yes, and is subject to shareholder approval at the AGM. No obligation exists on 31 December 2017. All right.
Yes.
So required treatment under IS 10. You are going to exclude this dividend from this proposed dividend from the main financial statements. No entry in statement of changes in equity or balance sheet. Instead, disclose the transaction details clearly within the notes to the financial statements. Is that clear?
Yes.
Comprehensive 2017 impact summary, financial statements, statement of changes in equity. I'm sure we talked about these statements some time ago. All right. It is also part of the statements which are required to be produced for a limited liability company. So, statement of changes in equity, the specific line item, we are going to have a reduction in retained earnings, the paid final 2016 dividend, and the paid interim 2017 dividend, right? So they all add up to 6,000. Why 6,000? Remember, there was a 5,000 first plus the 1,000.
1,000.
Yes, so they come to 6,000, which is, a reduction in our retained earnings. Then, for the statement of financial position, there is going to be a decrease in cash and cash equivalents of 6,000, the same amount. The statement of cash flows, cash flow under financing activities, we are going to have a reduction of 6,000. Statement of profit or loss, no entry. Dividends are an appropriation, not an expense. Imari dzevaridzi dzavanenge vachitora zvavo from maprofits takatoita statement of profit or loss ikapera vakutongotora mari dzavo adidika saka havisi kuaffecta that statement of profit or loss. Please bear that in mind.
Yes.
Bear that in mind. All right, so the financial impacts for the statement of profit or loss, there is no impact. Then notes to the accounts, disclosure of proposed final 2017 final dividend. Yes, and this should be disclosed. All right, so there's a disclosure for that proposed 2017 final dividend. Zvinganetsa here. Yes.
No.
This time wafaka kuzvipasira kure kuzvibvarura bvarura. All right, now we need to understand the reserves. We need to understand the reserves. They are what are called revenue reserves and capital reserves. Revenue reserves are created from retained earnings. Like I said, retained earnings are part of the reserves. If you still remember me telling you that. I told you that. So revenue reserves are created from retained earnings. These are distributable, meaning the company can pay them out as dividends to shareholders. Okay? So they are distributable reserves. Sometimes you see an entry like distributive reserve or distributable reserve. We are talking of revenue reserves. Then capital reserves include share premium and revaluation reserve. These are non-distributable and cannot be paid out as dividends. Okay, we'll talk about share premium, don't worry, and revaluation reserves shortly. Let's move on to the issue of shares. Patotangira cheko cheko. A company can issue shares at any price above nominal value. Okay, now when you go to register a company, you are given what is called authorized share capital for such a company. The registrar might say the authorized share capital is 50,000 for your company, and the number of shares, they would say 50,000 shares. You start your company with 50,000 shares. So those shares are given a nominal value. They're usually $1. Okay, each share is $1. All right, that's the nominal or the authorized nominal amount of capital per share. So each share would be having a nominal value or a book value of $1. All right. That's the ordinary value or the nominal value. But when you issue those shares to the public for them to subscribe to your shares, you normally charge an amount above $1. If the nominal value was $1, then you sell the shares at $2.50 to the public.
Okay.
The excess, the difference between $2.50 and $1 is how much? $1.50.
Yes.
Okay, that's the difference, right? So that difference is what is called the extra, which is credited to the share premium account. That's the share premium. The extra amount you get is the share premium.
Okay.
Is that clear?
Yes.
So when we issue shares, we get what are called proceeds. The money we get, that's the proceeds. So the proceeds, the $2.50 which you would have received, this 250 which you would have received is the total proceeds, but it includes the share capital nominal value of $1 and the share premium, which is the $1.50. Are we together?
Yes.
So share capital, when we talk of share capital, we are talking of the nominal amount. And the share premium is the excess price. Please get that in mind. Don't be confused. So here we said the total proceeds per share that was 250, which was equal to the $1 plus the $1.50. Okay, is that clear?
Yes.
Good. Let's look at this example. Galax Company. A company, Galax Co., is formed on 1 January 2015 and issues 10,000 $50 shares at a price of 50 cents each. Show the necessary entries to record this transaction and what will appear in the statement of financial position under the heading equity. So they issued shares, okay, issued 10,000 50 cents shares at a price of 50 cents each. All right.
Mm-hmm.
So what is going to happen? All right. So what is going to happen on this date? They issued 10,000 shares at $50 nominal, which means the share capital is going to be 10,000 multiplied by 50 cents. And this should be 5,000. This is the share capital. Is there any share premium there? No. Why? Because they issued at nominal. They were issued, the nominal value was 50 cents and they were issued at 50 cents. So no share premium here, no gain. Are we together?
Yes.
So this is why we have got a zero there on share premium. There's zero, right? Then on 30 June, what happened on 30 June? Part B. Let's do part B. The same company issued more shares on 30 June 2017. The issue another 20,000. Actually, they issued another 20,000 shares, which are 0.50 shares at a price of 8 cents each. So there is now an extra amount. So there is now a creation of the share premium because it was an amount above the nominal value of the shares. So 20,000 shares issued at 80 cents. The nominal was 50 cents. So this means that the equity, in terms under the share capital, remember the share capital here, we are looking at the nominal. This is the nominal column, and this is the share premium. So the nominal is still at 50 cents. So 50 cents multiplied by 20,000 shares, we come to 10,000 shares. Are we together?
Yes.
Then the extra, which is 50 cents minus 80, 80 cents minus 50 cents, that's 30 cents, multiplied by 20,000 shares, we get
6,000.
Do you get it?
Yes.
Good. So at the end of the year, we are going to have the total equity position at 30 June 2017 of, we are going to add these share capitals. The share capital here has increased because, remember, initially we said that the share capital remains constant. However, when we issue further shares, it changes, right? When we issue further shares, it changes, but it's not always the case. Usually, these shares are not going to be issued out on a daily basis. They are not a regular transaction. Do you understand? So this is why normally the assumption is that the share capital is going to be constant. But here, because we issued further shares, the share capital increased to 15,000, and there was also a share premium of 6,000. Is that clear? So this was the computation for the 6,000. Please, you might refer to that. Now let's talk of rights. Let's talk of rights and bonus issues. Rights issue. This is the offer of new shares to existing shareholders at a specific ratio. This issue of shares raises cash for the company and increases share capital. All right. So the shares are issued to existing shareholders. They are usually given at a favorable price to encourage allotment, okay, to encourage subscription, okay. Also, with the view that the reason why they prefer to subscribe to those shares, the reason why shareholders would love the idea is that it normally keeps the control of the company at the same pace. All right. There is no dilution of power. If the shares are issued to the public, there might be dilution of power. Somebody who was owning maybe 40% shareholding might end up being, owning less than 40% if the share issue is done to the public. So shareholders won't love that. They want to remain in control of their enterprise, and they will be motivated to subscribe for the shares. And also remember that they will be given at below market price, usually. Okay. So that's the idea behind these rights issues. What about the bonus? The bonus issue. These ones are free shares issued to owners. Sometimes they come and issue the shares free of charge. Okay. No cash raised. All right. No cash raised. Reserves, usually the share premium are converted into share capital. So they normally trigger some movement in the share premium account when the bonus issue is given. Let us see if there is no example here. Yes, we have got this example. At 31 December 2004, a company's capital structure was as follows. Ordinary share capital, 500,000 shares of 25 cents each. So of 25 cents each, that's the nominal amount. So what is the share capital? The share capital becomes 500,000 shares multiplied by 25 and multiplied by 25 cents, and we come to the share capital of $125,000. What about the share premium account? The share premium account was $100,000. All right. During the year ended 31 December 2005, the company made a rights issue of one share for every two held. So if you had two shares, you were going to receive one right share or one right issue share. Is that clear? All right. At $1 per share, and this was taken up in full. So how many shares were issued under the rights issue? Number of shares issued. They issued one for every two, multiplied by how many shares? We're talking of multiplied by 500.
Yes.
500,000. So it means that the total number of shares issued was 250. 250,000 shares. So these ones were for rights, right? For rights, 250. What about later in the year, the company made a bonus issue of 1 share for every 5. For every 5 held using the share premium account for the purpose. So 1 share for every 5 held. How do we calculate this? Hello?
Yes.
How do we calculate this one? Okay. All right. When this, remember this one was done
for purpose. Yes.
The bonus issue was done towards the year end. So we need to know how many shares were in issue by the time the bonus issue was done. How many shares were already in issue? Well, initially we had 500,000. Okay. But we then ended up having a rights issue, which triggered an issue of how much? Of 250,000 shares. So that's 500 plus 250. We are looking at 750 shares, 750,000 shares. By the time we did the bonus issue, we were having 750,000 shares in issue. So they then gave 1 for every 5 held. So 1/5 multiplied by 750. How many shares do we have?
Oh, use the share premium one.
Hello? You are now lost. You are now lost. You are now lost. You are no longer concentrating, right?
It's
I said,
150. Mm-hmm.
please pay careful attention.
Yes.
We were told that the company's capital structure was as follows: ordinary share capital, 500,000 shares of 25,000 of 25 cents each. So there were 500,000 shares in issue already. Okay.
Okay. Mm-hmm.
Then we made a rights issue to our existing shareholders for of 1 for 2 of 1 share per every 2 held, or for every 2 held. So it means that the number of shares issued under the rights issue were how much? That's when we calculated 1/2 multiplied by 500 there. Do you see that?
Yes.
And we got 250,000 shares. So this is why I added 500,000 plus 250 to get 750,000 shares in issue. So at the time when the bonus issue here, the last part, so this last part, when the bonus issue was done, we were now having 750,000 shares in issue.
Mm-hmm.
When? When? Hello? Uh, only got $3 here. Just $3. So it's weird, Maria. Okay. So we now have 750. Don't worry, I'll send you this video and you need to replay it. Okay. We now have got
Yes.
750,000 shares at the date of the bonus issue, and the issue was multiplied by one. They are going to give the shareholders one share for every 5 they are holding. So this means that 150,000 shares were issued from the bonus issue. So that's 1/5 multiplied by 750,000. That's 150. This is the total of shares issued under the bonus issue. Is that clear, madam?
Yes.
The rights issue triggered 250. The bonus issue triggered 150. So what is the total of shares now on issue? We started with 500,000. Then we issued rights. The rights issue were 250,000. The bonus issue 150,000. So how many shares do we have in total? How many shares?
This one is 4. 9. Isn't it 9?
Eh?
Isn't it 9?
900, right?
Yes.
If you simply say 9, Pela, I will be confused. But 50
It's
plus,
900.
yes, 900,000. And you were lacking confidence. So that's
But
900,000. These are
all
the
right,
total number.
what about this statement that is saying? What about the
And
statement that is saying and using the share premium account for the purpose?
all right, don't worry, we are arriving there. Okay, so
Okay.
I just wanted you to have some picture of what is happening. All right.
Okay.
Now the share capital and the share premium. What we are talking about, the actual figures for the share capital is also of paramount importance. We need to know what is happening. We want to see what is happening. All right, because by the end of the day, we need to have the values. Is that clear? We need to have the values. So we need to say, if we say for the share capital, because the share capital, the nominal, the share capital is accounted for using the nominal value of the share. So we are saying we have got 900,000 shares in total. I'm sure you're not yet lost. The 900, we
No.
calculated it there, right? Multiplied by
Mm-hmm.
0.25. That was the nominal. That's the nominal value of the share, isn't it? So how
Mm-hmm.
much? How much do you get? 900, 900,000 multiplied by 0.25. That's 225,000. That's the
Yeah.
amount for the share capital in our balance sheet. 225, right?
Oh, yes.
The 225,000. 225,000. That's how we obtained that. The 225. Okay. Now, the share premium. the share premium now, when we made the rights issue, the amount was $1, but the nominal value of the share was 25 cents. So we made a profit of how much? Of 75 cents per share when we made the rights issue. Do you still remember that? Okay. Are you
Yes.
seeing this? The rights issue.
Mm.
I don't want to when you are not understanding anything. All right. Mm, let us do this. Let me use the highlighter. Okay. The rights issue. This was these were the shares from the rights issue, right?
Uh-huh.
And these ones were from bonus. Do you get it?
Yes.
We have those figures. They are very, very pertinent. Now, when we issued the rights issue, the shareholders were made to pay how much? Dollar. They paid dollar per share. All right.
Mm-hmm.
For every two which they were holding, they paid $1. Okay. For every two.
Mm-hmm.
All right. Because they were getting one share for every two at $1 per share. So we want to determine the share premium. Share premium. So share premium, like I said, is the difference between the nominal value and the selling price of the share. All right. So now the selling price was dollar and the nominal value was 25 cents. So in this case, the share premium per share, the share premium is equal to 75 cents. All right. And how many shares were issued from the rights issue? They were how much? They were 250,000. Please, hey, be careful, right? We are talking of
Mm-hmm.
the 250,000. So how much is our share premium there? 75 cents multiplied by 250. You don't have a calculator. All right.
I have a phone here.
All right, let me do it. Let me do it. 0.75 multiplied by 250. 187,500.
Mm-hmm.
187,500. So that's the share premium from the rights issue. So how much in terms of total share premium do we now have? Remember, originally we had 100,000 share premium plus 187 500
Mm-hmm.
minus now minus the bonus issue, because we were told that the bonus issue is going to be catered for is going to be done from the share premium account. Do you see that?
Yes.
This was your word, isn't it?
Mm-hmm.
Now we need to know um, how much of the bonus issue shall we have to consider. We are only going to be informed. We are going to be informed. We are going to be informed by the number of shares from the bonus issue, which were how much? How many shares were from the bonus issue? And
187.5.
no, that one is the amount in dollars. This is the amount. This is the share premium of the rights issue, right? But from
Mm-hmm.
of the bonus issue, we talked of the 150 here, which I shaded here. Hello,
Yes.
please,
Yes.
please, please, oh, please, oh, auntie, please, oh. Be with me. Oh, so um, I know the it's now um a cluttered board now. There's a lot of writing here, but I want you to follow me, because if you don't follow me, then I'm doing nothing here. All the effort is going to be lost. Um, so for the bonus, don't worry, the answer is there. If we are wrong, we'll be corrected. For the bonus,
Mhm.
the number of shares, that's 150 according to our
Yes.
calculation. 150 multiplied by um the nominal value of the share, which is 25 cents, multiplied by 25 cents. How much do we get? 150 multiplied by 25 cents. Because the share premium is going to cater for the nominal value of the share which was given. We are not going to use the share premium amount. Why? Because the bonus shares are not going to be issued at a premium, because there's no money moving. All right. So what we are going to take from the share premium is the nominal value of the share of those bonus issues. So the bonus issue is 25 cents. So the nominal value of the share is 25 cents. So 150,000 multiplied by 25 cents, this should give us something like um,
87.
87.
No, it's 37.5.
Very eminent. I don't trust
And
you.
it's
Wow.
150.
You are correct. 37,500, which is fine. 37,500. So after we get this amount, we are going to use it to deduct our share premium. This is the amount we are going to lessen our share premium with. So that's 37,500. So our share premium is now going to be 100,000. Remember the original amount, right? Plus the
Mm-hmm.
187,500 minus 37,500, and we arrive at 250. As you can see there,
With
this
this.
is why they had the same amount. Do you get it?
Yes.
287,500 is 100,000 plus 187,500 minus 37,500 there, which is equal to 250,000. Ndofunga musikurasika amanye.
Hayiwa handichiriko.
All
Chekufamba
right,
tese.
better. Let's talk of something else. Revaluation reserve, IS 16. When assets increase in value, the gain is unrealized. Why? Because the asset was not sold. It is just an appreciation of value. All right. This profit goes to the revaluation reserve, not profit or loss. Remember, we talked of this revaluation reserve, revaluation surpluses, and so forth when we were talking of there was a lecture on non-current assets. Remember that. Okay. So IS 16, which is property, plant, and equipment, says that revaluation the revaluation is going to be recognized in the revaluation reserve. The revaluation gain or loss is going to be recognized in the revaluation reserve, not profit or loss. So, what we are simply saying is that when we come back to our statement of this particular statement, we are not going to find anything related to revaluation here,
Mm-hmm.
but it is something that is considered below the profit. In that statement, I said the other comprehensive income. statement. That's where we talk of the revaluation. It is not part of the profit computations as we are seeing there. Is that clear?
Yes.
Also, bear in mind that once an asset has been revalued, you then have to calculate the depreciation based on the revalued amount. Excess depreciation is going to be transferred to retained earnings. All right, that's it. Let us look at this particular example. Example NAMREC. NAMREC has a year end of 31 December each year. In a statement, in a statement of financial position as at 31 December 2002, she has buildings at a cost of 3,600,000 and accumulated depreciation of 1,080,000. Her depreciation policy is to charge 2% straight line. Okay, when you're talking of straight line, it means that every year you'll be charging, the same amount, same amount, same amount, same amount on the cost. All right. So the depreciation figures are not going to fluctuate, are not going to be different. They're just going to be the same throughout. On 3rd June 2003, the building is to be revalued at 3.72 million. 3.072 million. There is no change in the remaining estimated useful life of the building. Show the relevant ledger accounts for the year to 31 December 2003. Okay, so this is the mathematics you are likely to meet on exam day. All right, so I think what should be pointed out here is that at 31 December 2002, the building had a cost of 3.6 million and accumulated depreciation of 1.08. So how much was the depreciation? How much was the depreciation when the building was revalued on 30 June? So how much depreciation was being charged per year? That's the very important question. 2% of 3.2% of 3.6 million. What is 2% of that?
61,440.
61,440. So per year, she was charging 61,440. Now, we then have to know, because at the end of 2002, the accumulated depreciation was that one. So what was the net book value, the NBV? On 3rd June 2000 on 3rd June 2003. What was the NBV on 3rd June 2003? To get that, first of all, let us determine the NBV at 31 December 2002. So that was 3.6 million minus 1.080. So what do we get? We want the NBV for the building at 31 December. So that's 3.6 million minus 1.0. So that's 2520. Okay. 2520 or 2520. Was I correct there? Am I correct?
Yes.
Good. Now, we are told that annually they charge 61,420. So On 30 June, we just have to take the half of it, isn't it? 61,440 divided by 2. How much is that?
Sorry, so what?
We want the half year depreciation. So that's 61,440 over 2. That's 3720. So we need to deduct 3720 from 25 what? 25 what?
Mm.
So that's 2520 minus 3720. So that's 249, 2489, 891. My laptop, 280. So this was the NBV at 30 June 2003. Now we are told that there was a revaluation exercise. So the amount, the new value of the building was what? 307200. So what is the revaluation gain? The difference now is the revaluation gain. So that's minus 33072. So the revaluation gain, that's 582,720.
Okay.
582,720. So that's the revaluation gain. Revaluation gain. Okay. There's no change in the remaining useful life. Now, so it means we then have at 31 December, we just have to factor in. So we then have to say um, the new depreciation now, new depreciation, the new depreciation.
Yes.
There's now new depreciation to be done based on the new amount, the new the revalued amount. So new depreciation is now going to be 2%, 2% multiplied by 3072. This is the new amount, isn't it?
Yes.
Multiplied by half of the year, because remember the revaluation was done on 30 June, but we wanted the last half depreciation, the last half of the year depreciation. So that's it's been a long time since I did this thing. Oh,
Mhm.
yeah. 307200 multiplied by 2%, that's 0.2, multiplied by 0.05, which is half. 3720. How come? How come? Or we use the wrong figures. Hello?
Yes.
How come they're almost the same? What happened?
It's 3072.
But initially we found the same amount, or we were wrong. We used the wrong figure. Oh my God. Ah, did we use the wrong figures somewhere?
Um,
Well, they can't be this. They can't. They shouldn't be the same, isn't it? When we determine this amount here, when we determined um oh my God, I'm tired. I'm getting tired though.
2%
You must be
time.
observant. How come this figure is just the same with our figure? Oh man. Hmm? And you are asleep. You are falling asleep.
No, I'm up. I'm still up.
You are
Although
falling asleep.
I'm tired. Although
Hmm?
I'm not tired, but I'm up. I'm up.
I myself am tired as well. Oh my God.
It's 30.
Um,
It's 30,727.
hmm? What?
That's the
Okay.
amount.
I'm saying,
Uh,
for this other one, where did we get it wrong? We didn't use the right figure. We should have used 3.6 million, not that one. So mm, the annual charge here, the annual charge should be um, but we used this one.
yes.
And what was the half of this one? What is 61,440 divided by 2?
Okay, let me do.
Maybe you were right.
It's it's 61. 440 divided by it's still the same. It's 30,720.
Oh, so we are right.
Yes.
I was worried. I was worried. Okay. Now,
With the numbers.
eh, that's the beauty of
With the
numbers, right? The beauty or the burden or the pain. All right. So you have obtained this one. We have
yes.
obtained this one. So we need then to leave this one on the. This is the new depreciation, right? This is the new
Yes.
depreciation. So we're going to leave this one on the new asset, all right? On the new amount. So the new amount was this was the new amount. So we are going to reduce this one by that one. So we're going to say the new value now, that's 3,072,000 minus 30,720, and we get how much? That should be our net book value, the new net book value of the asset. So that's mm, minus 30720.
It's 3,041,280.
Yes, 3,041,208. 3,041,280. Uh-huh. Um, hey, look at this now. Uh-oh. Where did we go wrong? Um, the carrying value of the asset, that's 3 million minus 1.8 million plus 36,000 half year depreciation. Uh, 1.08, all right, which was the accumulated depreciation, uh,
Mm.
plus the half year depreciation, and they come to 2,484. Mm, we arrived at 248, 2489. Why is it so? Mm-mm-mm.
Ah.
484. Mm, half yearly they found 36,000. Why did we get 36,000? Half yearly we found 30,000. That's where we got it wrong.
Yes. So they say times 2%.
It could be
72 divided by 2. It's 36,000. It's 36K for 30 June. Because we say that 3,600,000 US times 2%. And then we say that amount divided by 2, and which is 72,000 divided by 2 for us to get the half
when
a year
when, when
depreciation.
36,000 multiplied by 2% is how much?
36,000 multiplied by 2%.
I mean 3.6 million multiplied by 2%.
Okay, let me do
Because you are the one
3.6
who gave me
million.
that's you were the one who gave me this 61,440. You understand? This why my
Yes.
figure.
So we say at
Mm,
3.6 million and
mm.
times 2%,
How much to get?
we get 72,000.
You see now. This is why I got it wrong. You see?
I
Uh,
think I was falling asleep here.
you see now. You see now. I won't
I
forgive
think
you.
I, I thought
Well,
I was now falling asleep.
you see that. All right, that's fine. That's fine. But you got the idea, right?
Yes.
Yes, you cross-check with these figures. The revaluation surplus, if your figures were right, we're going to say this is now the new revalued amount, the new value, minus the NBV at the date when the asset was sold. We get this 588,000, and we had obtained 582,000 because of those differences. Our gain was 582, but it wasn't bad anyway. Um, then the new depreciation for 6 months, right? For 6 months, that's 44, 44,542. But ours, the new depreciation was still the same. And this is why I was actually even worried, right? Was 30,720. But anyway, um, that's fine. All right. You may be confused with the way they are doing it about these years and so forth. You can still continue doing it with your 2%. All right. Um,
Yes.
yeah, because you might end up, confusing yourself about these things. Uh, then transfer from revaluation reserve to retained earnings. How much are we transferring? Remember the excess depreciation. Originally, the depreciation was 36,000, but because of the revaluation, it is now 44,000. So the difference here, the excess depreciation now we are charging because depreciation is increased. We used to charge 36,000 every year, but because of the revaluation, the depreciation has increased. Depreciation has increased. Are we together?
Yes.
So, yeah, that is going to be charged to the retained earnings. Is that clear?
Yes.
Good. Now, let's talk of something else. I think this is the last part, if not the second last. Preference shares. Yeah, because all these have been company accounts. Remember, company accounts. Okay, and what you then have to do is to attempt a certain question. I'm going to give you a certain question, and you are going to attempt that question. Um, I think I'll give you tomorrow morning, not tomorrow, but Monday morning. I'll send you Monday morning,
Oh,
boss. Yeah, I'm sending you
Tonight
Monday
are we
morning.
having another lecture, right?
Tonight, no, 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 not tonight, but Monday. I think Monday. Eh?
Even just for an hour, say even just a revision just for an hour.
Let's say Monday, please. Monday. Even
Monday.
today I have extended. It's almost 3 hours now. Do you understand? Please, right?
3 hours atisati dzakwana.
And I do that. Totanga 11 shama kusada.
Atatoke kuma tutopse.
Ndiwangochinetsa kausingabatiki sha ndenge ndagara pamushini from 11 and you see so 11, 12, 1 is now almost 3 o'clock. I mean into the third hour. They number push on. Oh, you pass, please, on Monday and Monday after week and to that deal.
Okay. All right.
I'm going okay. I'll actually bring a question. Yeah, chaitani Monday. Chona sana kuti zvakamira sei. Past exam. I think about past exam questions. We're going to do past exam questions on this aspect, so that you're not offended.
Okay.
Please.
Yes.
I'll try also to send
Yes.
this video on Monday morning, so that unokwanisa
Okay.
futhi kubatsirika. And it
Okay.
right. Preference shares. Uh, when we talk of preference, we are simply saying that these are the shares which are preferred more than the ordinary shares. They are preferred more to ordinary shares. They're actually preferred to ordinary shares, which means they are given more preference. They are given first preference, and then shareholders, the ordinary shareholders are going to be given the second preference. But these ones are given first preference, right? When you pay dividends, you first have to cater for these guys first before your ordinary shareholders. So the preference shares can be redeemable or irredeemable preference shares. Redeemable preference shares are classified as a liability. Dividends are treated as interest expense. The dividends for this are treated as interest expense. Whereas the irredeemable preference shares, these ones cannot be repaid. When you are saying irredeemable, you are saying that the capital amount is not going to be repaid. The capital amount is not going to be retained to the contributors. The company is not obliged to retain the capital amount. Let's say people have come to buy 10,000 shares for $1 million. If they are redeemable, it means that they are going to be given their money back. But if they are not redeemable, they are irredeemable, it means that that money is gone. They are only entitled to a dividend. So in that case, irredeemable preference shares are classified as ordinary equity. Dividends are appropriations of profits. So ndo chete zviripo
Mm-hmm.
unofana kumbobata katriki kako handina. All right, let's
Yeah.
look at this example. A company is in issue 10,000 5% preference shares. The 5% is the interest, is the dividend rate, is the dividend rate or the interest expense rate, something like that. So
Okay.
the number of shares is 10,000. It attracts 5% interest or dividend rate. They are preference shares of $1 each. So the nominal value for these preference shares is $1. The dividend is payable half yearly. How much dividend will the company pay each time? So they pay half yearly. So which means when you calculate the annual dividend, you then have to divide by 2. So uh, the annual dividend is equal to 10,000 shares multiplied by the nominal value of the share multiplied by the rate, the dividend rate, the percentage, that 5% preference share, the 5%, and you get an annual dividend of 500 pound or $500. All right. But the frequency is that we pay these dividends half yearly. So we are going to divide the annual dividend by 2. So each time they are paying a dividend of 250. Priority. This dividend is paid before ordinary shareholders. before the owner shareholders can receive their own. These ones, they are paid. Now, the financial reporting summary. So the statement extracts, the equity section, the statement of financial position extract. Under the equity section, we have got the ordinary share capital, then the share premium, the revaluation reserve, which is from the other comprehensive income, then the retained earnings, then we come to total equity. Any questions, Madam?
No.
Yeah. In essence, we've done everything, and like I said, we are going to do a past exam question paper. Question on this aspect. I'll look for 3 competent questions, and I want you to revise this section. You need to revise this section. I'm going to send you these slides, and then the video is going to
Okay.
come. Yes, I'm going to send you right away these slides so that you are comfortable with the learning experience. Anyway, thank you so much, madam. See you when you see us in the next episode.
Okay, thank you, sir.
All right, you're welcome.